Hey guys, this is Rudy, Full Investor Investor, coming at you from Florida this afternoon. It is December the 1st. I want to talk a little bit about Occidental. On our YouTube channel, I just received a comment from Jeff Sienna who mentioned that he doesn't know how to trade Oxy, so he kind of remains long. That's not necessarily a bad thing. I remain long as well. I have no particular motivation to actually sell Oxy, especially not at the current price. I believe Occidental Petroleum is worth much more than $15, which is kind of where it closed today. But what I thought I would do with you is kind of discuss a strategy in the event that you might be interested in potentially trading Occidental. And obviously, there's a really good chance that some of you might be sitting on a big fat profit, especially if your timing is impeccable and you manage to get into Occidental as a position that you opened, let's say, a month ago, which means that you bought Occidental for around $9, and today it closed at about $15. So it's not quite 100%. But if you timed it really, really well, you would have come in at about $8 and sold when you were at $16, which is 100% profit. But the actual really significant topic that I want to discuss with you in terms of a strategy is that you really have three choices when the market fluctuates and stocks are going up and down and up and down and up and down. And Occidental, of course, is even more volatile than most. You can either stay long and strong, in other words, just do nothing and wait, or otherwise you can sell at a loss if you were in a loss situation, or otherwise you can take your profit when you have the profit, and then of course you can buy back in again whenever you want to. I'm not trading Occidental, so I'm not even recommending it, but what I wanted to talk to you about is a trailing stop sell order specifically. There's a whole variety of different ways in which you can actually exit a position kind of safely. One of them is called a trailing stop. If your online brokerage system does not offer you the functionality to do a trailing stop, then you should probably change your online brokerage to something that actually provides better functionality. How it works is simply like this. So I'm going to kind of probably disappear a little bit off screen here, but just follow with me as you can. And by the way, this is a perfect artist rendition. I know because I did it. And obviously my artistic skills are quite impeccable if you look at the way I scribble on the blackboard. But if you look at the Occidental share portfolio performance over the last month, this is November, starting on November 1st and ending on November 30th. And then I just scribbled in there today, closed at $15. So what happens with the trading stop is you decide how much of a loss you are prepared to accept once you get into a profit situation. So you don't buy Occidental at $9 and then plug in a stock right away, a stop. But although you can do that if you want to, because you could say, for instance, I'm not prepared to lose more than 10%, just as an example, which means if Occidental is trading at $9 and it drops down to $8.10, your position is going, that trading stop that you enter is going to execute. It's going to become a sell order. And once it executes, then you've gotten out of the position and you've lost 10% of your money. What you really want to do is you want to look at plugging in a trading stop when you've had some gain. So if we look at the chart over here, we see sort of around the middle of November, Oxy had moved from about $9 to about midway between where it is today. So let's call it $12 or thereabouts. So if you got into Oxy at $9 and you went up to $12, at that point in time, you're already up 33.33%, right? So basically what you're doing is you're saying, okay, I'm at $12. If Occidental now were to drop more than 10% or 5% or whatever you plug in, let's just use 10% as an example because it's easy. So I'm at $12. If Oxy loses $1.20, which is 10%, then at $10.80, I'm going to sell out and I'm going to cash my profit. I'm going to take the profit that I make on Occidental in terms of the position that I'm in. The reason why it's called a trailing stop is because if you plugged in a 10% trailing stop, then your stop order will trail the stock as it goes up, 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 up in this case. And once you get to your $12, you plug in the stop or whatever. After that, if the stock were to tank or crash, then whatever the price is at that moment in time, less 10% is what you're going to execute your sell order at. So right now, sort of like at the end of November, theoretically, because this was at the end of December 1, so November plus 1 day. We ended the month at $15. 10% on $15 would be $1.50. So at $13.50, I would exit the position if I had a trading stop plugged in at 10%, because during this decline year, it did not go down 10% towards the end of the month. It topped out at about $16, what was it, $16.87 or something, and then dropped down to about $15, where it sort of finished today. So you kind of get where I'm going. A trailing stop sell order trails the stock as it goes up, 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 up. So I've used this successfully in the past, because what I've done is, where I've had positions where I've been up 30, 40, 50%, I plugged in a trailing stop of 5%. And then what you're doing is you're saying, I'm up 30%. If the stock pulls back 5%, I'll exit the position, cash my 25% profit, and call it a day. And of course, I can always buy back into it again if I want to, at the lower price, assuming it's going down, 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 down. So you get where I'm going with a trailing stop, right? It trails the stock as it goes up and down. If it goes down and you plugged in, let's say, a 3% stop or a 5% stop, as soon as the stock were to drop 3% or 5%, it's going to execute, create a sell order. And once it's executed, you've effectively exited the position, and you are no longer holding that particular stock, but you've cashed your gains. Of course, the reverse is true if you're long and you got in on the position, let's say a long time ago, before it even got to $9, because you could say, but wait a minute, Mr. Oxy, I mean, this is like sort of a little scam here, because what if I bought Oxy in January? Because in January, the price was not like $15 or $9. You might have gotten into the position for the first time at a much higher price than where it's currently trading. So you would be correct if you say that, and I knew you were going to ask that question. So on the other side of this blackboard, so if you forgive me for a second, I'm just going to turn my back to you, because I want to turn the blackboard around, because what I did on the other side of the blackboard is I drew, once again, using my impeccable artistic skills, Occidental stock performance for 2020. And you might think that this is not a perfect rendition of what Oxy did in 2020, but it is. You know, like I'm really good at drawing like just one line on a blackboard, especially on a blackboard, because I can erase it and do it again and erase it and do it again. And you know, this was actually like one take. You know, so it's this is my best work. But this is Oxy in 2020. Okay, so let's say you purchased Oxy over here. And what happened then? You know, so this is my $40 line over here, and there's a $20 line over here, and this is January through October, and obviously this is the actual chart of Oxy in terms of its performance year to date, starting actually sort of in December over here at the beginning. But we hit a high there in Occidental of way over $40. I'm not sure what the price was in January. I don't remember, but it might even have been as high as $50. But let's say you purchased Oxy for the first time. You opened a position in Occidental, and now you acquired this stock, this common stock, at $50. And now you're in a deep hole, right? Because Oxy obviously currently is trading at around $15, and you started at 50. If you had plugged in a trading stop here, when that first little mini crash happened, sort of in towards the end of January, early February, your position would have exited and you would have lost money. Then you could have plugged in a trailing stop again here and went up, 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 and your trailing stop would follow the trajectory of the stock as it moved up. And then we had a huge crash in March. If you had a trailing stop plugged in, it might have executed at 5%, 10%, 15%, whatever you are comfortable with in terms of taking a loss. I don't like taking a loss at all. In fact, in theory, I never take a loss. And the reason for that is that if I'm in a situation where I'm hopelessly underwater, I mean, much like you, I have three choices. I can either sell the stock and eat the loss, which I don't do, or otherwise I can say, I'm just going to do nothing and wait, which I've done many, many times before, or otherwise I can buy some more, which in the case of Occidental, if you've been following my channel, you would know I've done this a couple of times. So in the case of Occidental, for instance, the very first position that I opened in Occidental was at a price of around $53 or $56. That was even prior to the Anadarko acquisition. And when the Anadarko acquisition happened, I was really happy because I thought this was going to be a good move for Occidental. It turned out to be a less good move. And then, of course, the pandemic happened, which was even worse. But during that time, I've been adding to my position all the time, and my cost basis as a result dropped from like, $50 down to like, say, $20 or whatever the case might be. So what you want to do here is, let's say, for instance, you purchase this stock. So you open the position in January and you bought Occidental for like $50. And then it crashed, went up a little bit. And then it really, really crashed in March. It went down to, what was it, about like $8 or $9 or something like that. We had a little uptick. And then everybody started talking about a V-shaped recovery, right? And we said like, oh, okay, this is like, post-pandemic. It's a V. It kind of wasn't, because energy kind of just kept tanking anyway. Now, once again, to protect your gain, if you were lucky enough to time the market and you bought some cheap Occidental there, or if you bought some really cheap Occidental here, then you could have plugged in a trailing stop, and you could say, for instance, if the stock drops by 3% or 5% in one day, exit my position, I'll cash my profits and take my gains and go away. That's why it's called a trailing stop. It just trails the stock. As the stock moves, the trailing stop just sits there, waiting to execute when it hits your trailing stop order price, your stop limit price. You can do this as a percentage. You can say if it drops 3%, I want to exit, or you can do it as a dollar value. So you could say, for instance, Occidental is trading at $40. If it drops to $38, sell, right? I would only really use that, firstly, if I was trading Oxy, which I'm not, or otherwise if I wanted to take a big fat gain that I'm sitting on and cash some of that profit instead of just putting it at risk or losing it. You also have another thing that you can do, which is called last in, first out, which is LIFO, or you can go first in, first out. So when you actually book your trailing stop order, you can say the first stock that I bought in Occidental, first in, first out, is the stock that I want to sell. So in other words, let's say I have a total of 5,000 shares. I might say I want to sell 1,000 shares of the stocks that I bought first of Oxy, which means I want to sell 1,000 of the shares that I bought at $50. And I might sell them at $20. And there's a reason why we do that too, because it's called tax loss harvesting for the most part, unless you're just happy taking losses, which I am not. So as Oxy goes up and down as the market fluctuates, and of course Oxy is very volatile, you can consider this. And once again, if you were very fortunate to get into Oxy sort of at the end of October, early November or so, then you've actually bought more Oxy stock at about, $8, $9, $10, maybe even $11, and it's currently at $15. You can say, you know what, I'm just going to trim that profit off the table. So Jeff, in response to your comment that you posted on the channel, I just want to say that you don't have to sell everything, and you don't have to buy more. You can do nothing, or otherwise you can sell at a loss. These are the choices that you have. But what you can also do is you can say, I'm going to trim just a little bit. So if you add it to your position right there at the bottom, if you were kind of lucky enough to time the market and you got some Oxy at $8 or $9 or so, you could say, I'm going to plug in a trailing stop at 3% or 5% or something like that. And I'm going to sell the last in, first out lot. I'm going to sell 1,000 of those Occidental shares that I bought for, let's say, $9, less 5% of the closing price, which today is around $15. So just in terms of simple math, $15, 10% would be $1.50. So 5% is 75 cents. So I'm basically saying, using 5% as an example, Occidental is trading at $15. If it drops by 5%, which is 75 cents, I'm exiting my position just for the lot that I bought last in, first out. So I'm going to sell 1,000 shares that I bought for $9 at $15 less 75 cents. So that's $14.25 off a cost basis of $9, right? So you're just trimming a little bit of profitable Occidental stocks off the top of your holdings. I hope this makes sense. The thing that I'm sharing with you is that you can use a trailing stop in order to protect your gains, and from time to time, take a little bit of cash off the table, take some profit, sit on the cash if you want. You can always buy something else, or you can effectively say, I'm going to buy back into Oxy again. You've got to be careful though, because if you sell Oxy at a loss and then you buy back into Oxy again, that's a wash, and you're not going to be able to deduct that tax loss for tax purposes. So I hope it's sort of useful to you, and I hope that I've made it clear. but that's the trading stop. I've used it very frequently in the past, so I've used it on a number of occasions. It works. It's a great way to protect your gains. So anyway, let me know if in the comments if I made sense or if I need to explain this in a bit more detail. Thank you for watching. If you like my videos, please hit the subscribe button. And I will see you guys again soon. I have my call with Occidental Investor Relations coming up tomorrow afternoon, which is December the 2nd. After that, probably on Thursday or Friday of this week, I'll post an update and let you know some of the discussion that we had with Investor Relations. So on that note, protect your gains, make lots of money, stay safe, and we'll see you again soon. Thanks for watching. Thanks for your time. Bye-bye.